Welcome to our video on fractional reserve banking. In this educational series, we'll uncover the essential components of this pivotal financial system. Fractional reserve banking is a practice where banks keep a fraction of their deposits in reserve and lend out the rest. This process is instrumental in our modern economy, influencing how banks operate and manage funds. Today, we'll begin with the fundamentals. What exactly is fractional reserve banking? How did it originate and evolve over time? Understanding this will set the stage for a deeper exploration of its impact and significance. From the early days of banking to its current role, fractional reserve banking has undergone significant transformations. Its development is intertwined with the history of money and commerce, highlighting both challenges and advancements over centuries. Our goal is to demystify this concept and break down its complexities into digestible insights. Whether you're an economics student, a finance professional, or simply curious about how our banking system works, you're in the right place. As we dive deeper, you'll learn not only about the mechanics of fractional reserve banking, but also its implications. Stay tuned to see how this foundational practice shapes our financial landscape, influences monetary policy, and impacts economic stability. Now, let's embark on this journey and explore fractional reserve banking's past, present, and future. Welcome back. Now let's dive into the basics of fractional reserve banking. At its core, it allows banks to keep only a fraction of their depositors' money in reserve, lending out the rest to create additional liquidity and stimulate the economy. Here's how it works. Imagine a bank receives $100 in deposits. With a reserve requirement of just 10%, it needs to keep only $10 in reserve. The remaining $90, that's available to be loaned out to individuals and businesses. This concept significantly expands the lending capacity of banks. By lending out the majority of deposited funds, banks can support more loans, investments, and economic activities. Essentially, banks are turning every dollar deposited into multiple dollars circulating in the economy. Let's put this into a typical example scenario. If you deposit $100 into your account, the bank holds $10 and lends out $90. That $90 might be used by someone to start a business, and eventually they deposit their earnings back into the system, allowing the bank to lend even more. Through this process, fractional reserve banking enables economic expansion and facilitates financial growth. But it also introduces complexities and potential risks which we will explore later. Stay tuned to see how this practice affects our financial system. Our journey into the world of fractional reserve banking brings us now to its roots. Let's unwind the clock to its origins. The concept is not new. It stretches back to the early days of banking when goldsmiths realized they could issue more promissory notes than the gold they actually held. As trade flourished and economies expanded, this practice evolved, laying the groundwork for modern financial systems. By the 17th century, fractional reserve banking had taken shape in Europe, becoming integral to the operations of commercial banks. Pioneers like the Bank of Amsterdam played a significant role, setting a precedent for future banking practices worldwide. Over centuries, key milestones transformed the system, from the establishment of central banks to legal regulations mandating minimum reserve requirements. These moments not only sharpened the system, but also highlighted its potential and risks. As we uncover these historical milestones, we gain a clearer understanding of how fractional reserve banking has evolved into the robust yet complex mechanism it is today. Join us next as we delve into the pivotal role central banks play in this intriguing financial landscape. Central banks play a crucial and often unseen role in the world of fractional reserve banking. By setting reserve requirements, they determine the minimum amount of reserves a bank must hold against its deposits. This, in turn, directly influences how much money banks can lend. But their influence doesn't stop there. Through monetary policy, central banks steer the economy towards desired outcomes, whether it's controlling inflation, managing employment rates, or ensuring economic stability. Their decisions on interest rates and money supply can ripple through the entire financial system. Without central banks, the delicate balance of lending and reserving would unravel, potentially leading to financial chaos. As we move forward, we'll delve into the benefits that fractional reserve banking brings to the economy making it clear why central banks' involvement is so crucial. Fractional reserve banking boosts the economy in several impactful ways. Firstly, it significantly increases the lending capacity of banks. By holding only a fraction of deposits in reserve, banks can lend out the majority of deposits, fostering business growth and personal investments. Secondly, this expanded lending capacity promotes economic growth. When businesses and individuals have access to credit, they can invest in new projects, stimulate job creation, and drive economic activity. Lastly, fractional reserve banking is instrumental in managing liquidity within the financial system. It ensures that banks have enough liquid assets to meet their customers' needs while still being able to provide loans. This balancing act helps maintain the stability and efficiency of the financial system. As we move forward, you'll see how these benefits compare to the risks and criticisms that fractional reserve banking also entails. Despite its many advantages, fractional reserve banking is not without its share of risks and criticisms. One of the most pressing concerns is the risk of bank runs. This happens when too many depositors withdraw their money simultaneously, fearing the bank's insolvency. Such events can quickly spiral into widespread financial instability. Critics argue that the fractional reserve system inherently carries these risks, as banks only hold a fraction of their total deposits in reserve, making them vulnerable. Eminent economists have pointed out that this structure can lead to liquidity crises, where banks struggle to meet withdrawal demands. During financial downturns, this system's fragility can exacerbate economic woes, as seen during past crises. While regulatory measures aim to mitigate these risks, they remain a significant point of contention in financial discourse. As we delve deeper, we'll uncover historical instances and major lessons learned from these challenges. Stay with us as we continue our journey through the complex world of banking, shedding light on the pivotal moments that have shaped our financial landscape. The 2008 financial crisis highlighted some of the deep-seated risks inherent in fractional reserve banking. As banks held just a fraction of their depositors' money in reserve, they faced tremendous pressure when those depositors scrambled to withdraw their funds. This led to liquidity crises, exacerbating the already spiraling financial meltdown. One key lesson learned was the necessity of more stringent regulatory oversight. Financial institutions and policymakers recognized that unchecked leverage and insufficient reserves could destabilize the entire economy. The crisis spurred the development of new regulations aimed at increasing banking transparency, improving risk management, and ensuring higher reserve requirements. We also saw significant changes in the way banks operated. They began to emphasize stress testing and the creation of more substantial capital buffers to weather future economic storms. As we delve deeper, it's crucial to understand how these regulatory adjustments influenced modern financial practices and what further reforms might be on the horizon. Stay with us as we explore how today's banking environment has adapted to prevent another crisis. In the next segment, we will look at modern banking practices and the advancements that have been made to mitigate these risks. Modern banking practices have undergone significant transformations to address the inherent risks of fractional reserve banking. Today's regulations are more robust, ensuring that banks maintain higher reserves to safeguard against potential financial crises. Technological advancements have also played a crucial role in this evolution. From blockchain technology to advanced risk management tools, these innovations have enhanced the stability and transparency of the banking sector. But the changes don't stop here. As we look to the future, trends like artificial intelligence and machine learning are set to further revolutionize banking practices. These technologies promise even greater efficiency and security, offering the potential to predict and mitigate risks before they materialize. Through regulatory changes and technological advancements, banks are now better equipped to manage risks and ensure financial stability. As we move forward, you'll see how these modern practices impact the broader economy and shape the future of finance. Stay with us. Fractional reserve banking plays a crucial role in the broader economic landscape. By influencing credit availability, it has a direct impact on economic stability. When banks hold only a fraction of their deposits in reserve, It allows them to extend more loans, thereby fostering economic activity. But this system also introduces long-term effects. Over time, increased lending can lead to economic growth, but it can also pose risks, especially if not managed properly. Regulatory frameworks help maintain a balance, ensuring that economic stability is upheld even as credit availability fluctuates. As we've seen throughout history, the principles of fractional reserve banking remain integral to how modern economies function. This dynamic interplay between reserves and credit shapes not just individual financial decisions, but the broader economic trajectory. Understanding these impacts helps us appreciate the complexity and significance of fractional reserve banking in our lives. As we move forward to our concluding thoughts, let's summarize the key takeaways and reflect on the future of this essential financial system. As we conclude our exploration of fractional reserve banking, let's recap some of the key points we've covered. We've seen how fractional reserve banking works, its historical context, and the crucial role central banks play in regulating this system. We've also explored the benefits, such as increased lending capacity and economic growth, as well as the potential risks, including financial instability and the threat of bank runs. The 2008 financial crisis served as a stark reminder of these risks, prompting regulatory changes and modern banking adaptations to mitigate them. In summary, fractional reserve banking is a cornerstone of our financial system, characterized by both significant benefits and inherent risks. By understanding these dynamics, we can better appreciate its profound impact on the economy. Thank you for joining us on this educational journey. If you found this video informative, please like, share, and subscribe for more content on economics and finance. Keep learning and stay curious about the world of banking and financial systems.